So for my realtors, we just did a presentation in our office for a monthly lunch and learn about bridge loans and HELOCs and how they can help save your deals and win you more listings. So let's go over the options. Now, the way a bridge loan works is we are essentially fronting them the equity from the home that they already own to go towards the purchase of a new one, whether that be as a partial amount for a down payment with another 30-year loan attached to it, or covering the full amount with the remaining money they have in their account, which essentially would be the same as a cash offer. And then the way bridge loan works is they are paying an interest-only payment on that bridge, and it needs to be paid off within 6 months with them finally selling that home. So this is a great option to remove the home sale contingency, because that home has another 6 months after closing to sell. It doesn't have to sell beforehand. So who is a bridge loan for? First off, this needs to be well qualified credit individuals. So typically a 700 score and up, and they need to have a lot of equity in their home. This is not for someone who has 5% equity. We can only go up to 75% loan to value, so they have to have at least 25% equity in their home. There are also closing costs on the bridge loan. So the bridge loan will have its own closing costs, and then the new purchase would have its own closing costs. So the borrowers will likely be either coming out of pocket for that, or will need to have room to roll that into the loan if they're getting a new loan. Another big factor with bridge loans is the debt to income ratio if they're going to be getting a new loan, especially. So we're typically taking on a lot of risk with a bridge loan. We as the bank rarely make money off of bridge loans because most people are going to pay that loan off fairly quickly. So we do have to look at debt to income ratios. However, it's also a loan that we as a company get to decide our own tolerance levels on. So there's no set debt to income ratio, which is great. And we can technically pay off debt through that bridge loan if we need to help qualify. So let's look at a pretty easy scenario. So we're going to take someone that has a $400,000 house. We're going to say that it's paid off. So they're able to take out 75% of that equity, so $300,000. That's going to be applied to the purchase price of the new home. So let's say they're buying another $400,000 house. We have the $300,000 from the bridge. That's going to be applied with another $100,000 of their own funds. So stocks, bonds, 401k, cash, just like normal, to reach that $400,000. Now you are putting in a cash offer because there is no new loan that's being created. It's just that 6-month bridge, and we provide a pre-approval letter stating that. So again, in this instance, it's ideal. They don't have a lien on the house. We're taking out the majority of it, bridging it over, adding their own funds to create a cash offer. Now let's say in the same scenario, that person doesn't have $100,000 available in liquid assets. Then we would do a bridge plus a new loan. So same scenario, $400,000 house that's paid off. We can take out $300,000, bridge that over. On the new $400,000 house, that $100,000 could go in as a new 30-year loan. And so they have to qualify to be able to make that new payment plus their interest-only bridge payment. But that allows them to essentially not be bringing money at closing other than their closing costs, which sometimes can be wrapped into the bridge loan as well. So either way, that removes the contingency of having to sell that home first, because we're going to go ahead and front load that equity and bridge it over, and then they have 6 months to pay it off. Now, in both of these scenarios, that agent has the potential to have multiple sales. So they may be able to represent the person for the sale of their home plus the new purchase that they want to make. So that could be 2 deals for you off of this bridge. This bridge is something that's there to kind of save us in a pinch. It's not something everyone will use, but it is there to save us. And we don't want to have that home sale contingency and people are struggling to get their houses sold faster. Another tool we use a lot that can help with your listings and create more business are HELOCs. So HELOCs, or home equity lines of credit, are essentially a credit card on your own equity. However, if you think of a typical credit card that's got 20 to 24% interest, HELOCs typically have around 8 to 9% interest rates. HELOCs can be taken out before a home is listed. You can use that HELOC money from the equity to do paint, replace the roof, replace the HVAC, all of the items that make it difficult to get a good list price on a home or that make buyers wary of purchasing. A HELOC can be used to go ahead and make those renovations, and then the HELOC is paid off when they sell the home. We use HELOCs on the banking side for quite a few things though. Some people use them for debt consolidation purposes, to pay for education costs, for personal use, or what we also see people using, which can also create deals for you guys, is they may take equity out of their primary home to finally be able to go and buy an investment property and put a significant down payment down. So that is another thing to talk to your potential buyers about who are looking to buy investment properties who may already own another property. But either way, bridge loans and HELOCs are both listing and buy saving methods that we use at Atlantic Coast quite often. If you have any questions or want to run scenarios, let me know. I am personally licensed in North Carolina, South Carolina, and Florida, and we have loan officers that are licensed in almost every other state who can help you as well. Thanks.